Welcome to the Sustainable Multi-Asset Quarterly Investment Update. So over the last 3 months, equity markets have struggled for direction after a blockbuster first half. We've also seen bond yields rise as central banks became more hawkish. So the three main points that we've seen develop over the last 3 months are firstly, central banks saying that they're going to have to raise rates and keep rates much, much higher. This has priced out rate cuts for next year, and therefore the long end of the yield curves have started to rise significantly. Secondly, we've seen value stocks make a comeback against growth stocks, reducing the underperformance for this year. This is because growth stocks have been able to be immune to rising bond yields so far, but actually this has changed over the last 3 months, and growth stocks, with their present value of future earnings reducing, has also meant that their prices have come down. And lastly, the fact that the oil price has spiked up to $100 a barrel. This is post the confirmation by Saudi Arabia and Russia of supply cuts, and confirming that they're actually going to continue this towards the end of the year. Now, we've seen increased demand from China, and this has obviously led to a supply shortfall. And indeed, when we look at where peak oil expectations have changed, they've really started to come in from 2030 towards 2026, and therefore this is putting pressure on the oil producers in order to keep prices higher. Our risk-off stance has not delivered so far this year, but we do see increasing risks for the rest of 2023 and into 2024. We see these risks firstly in the equity market, where valuations have disconnected from the fundamentals, and the fact that rising bond yields has taken some of the froth out of the AI boom that we saw at the start of this year. Secondly, we're waiting for a time to re-engage in going long duration. We're not fighting the momentum in bond yields, in government bond yields, because interest rates have not peaked, and you've seen that interest rate cuts have been priced out next year. So there's a huge momentum for higher yields, and we don't want to necessarily fight that at the moment. So we're looking for better places to engage long duration positions in our portfolios. And finally, our emerging market position has bounced back a little bit in Q3 as the stabilization in China and the froth around AI has dissipated. We still believe that China is on the path to recovery. We've seen stimulus come from the government, and we believe that China and the Chinese equity performance is the key to unlocking performance across emerging markets versus the rest of the developed world. Over the quarter, the Fineco portfolio delivered a return of minus 1.2% in absolute terms. But this was ahead of the long-term strategic benchmark of minus 1.6 return over the quarter. So the fund outperformed its long-term benchmark. This is down to two parts of the portfolio. Firstly, in terms of the equity portfolio, we saw a slight outperformance of emerging markets versus developed markets, and we saw that our quant approach in emerging markets actually generated alpha at the overall portfolio level as well. We also saw that value outperformed growth, which, as we have a value tilt in the portfolio, was additive to performance. And finally, even though equity markets were down over the quarter, our sustainable global stars portfolio outperformed significantly from the stock selection within the portfolio. In the fixed income markets, we had a bit more mixed results, with our QI dynamic duration portfolio outperforming significantly because they were very short duration over the quarter and therefore performed exceptionally well. On the other side, we saw a drag from our exposure to emerging market debt. Thank you very much for listening, and talk to you next quarter.